everybody. It's Michael Carlin, president of Henry+Horne Wealth Management. Today, I wanted to take a few moments to go through inflation. There's a lot that's been going on with the market lately. There's a lot of new concerns that are coming in as we are worried about new COVID variants. We're worried about, can the market continue its amazing and rather torrid pace that it's had back the past couple of years? And inflation is one of the key elements that is going to unlock what's going on with our stock market, what's going to unlock what's going on with our economy. And in an effort to try to answer all the questions about inflation, what we did is spend time gathering and putting our arms around data, not just what it is looking like today and in the future, but on a historical context so that we can figure out where it's going. So I'm going to try to take the next few minutes, this block of time to go through and answer all your questions about inflation. Right now, what we're looking at for 2021 and going into 2022. So I'm going to go ahead and share my screen here in just a second. And I will take us through a bit about what we're looking at. So if you can see on the screen, we're going to talk about inflation trends broadly speaking. Let's just get right into it. The Fed has set an inflation target. What they wanted the inflation target to be was 2%. You might hear me referring to that a few different times throughout the course of these slides. And it's never been an easy target for the Fed to keep. And it's evidenced here by this chart. This historically shows what inflation has done. So if you follow along from 1960 through the ultra high inflation pockets of the 70s and early 80s, and what inflation's really looked like over the past couple of decades, we've been in this 2%, as high as 4%. You've had a recession or two where inflation went down to 0 and in some cases negative. But again, inflation or the cost of living rising every year is something that the 2% number the Fed has shot for forever. So what they've been trying to do is use the Fed's balance sheet. They've been trying to manipulate interest rates, do different quantitative easing programs so that they can create an environment where the Fed is going to be able to control interest rates and keep them, really, really locked down tight. They haven't had a lot of success. And you can see, even despite everything the Fed has done, and we know the Fed's done a lot lately to the market and the economy, inflation has spiked significantly, so much so it hasn't been this high in decades, really 30-year highs. So it's been quite impressive to see just how high and how hot inflation has been. And one of the concerning things that we're seeing is that, growth and inflation, both of those things are expected to accelerate, but the rate of acceleration for both growth, economic growth, and inflation, the rate of growth is slowing. That's a good thing in terms of inflation. We would like to have a nice, smooth rate of inflation. If the cost of living goes up by 2 to 3% per year, it's a nice, healthy number where prices for goods and services can go up, businesses can make more, payrolls can go up a little bit, but it's not these kind of catastrophic amounts. When you start to get into this 5-6% inflation number where we've been, it's like, whoa, our business profit's going to hurt. How do we pass along those costs to consumers? How much is this going to change the consumer's balance sheet, having to deal with those increased costs? So the rate of inflation is expected to slow down and expected to decelerate. Again, still supposed to be a little bit hotter than normal, but coming back down to reality. The rate of growth is expected to be better than it has been, but the rate that growth is increasing is starting to slow a little bit. We think inflation has got a pretty significant component of it. And when you look at inflation, it's interesting to note that we've been showing these hot numbers. We've been posting numbers, like I said, in the 5%, almost 6% range for inflation. And that's not entirely accurate. We all know that year over year, we at least should all have seen anecdotally, the price of residential real estate has gone up a lot. Nationally, it's gone up about 20% year over year. And a huge component of the price for homes is not a component in CPI, inflation. It's not, because if home prices were a significant component, it's certainly to the extent to which, 42% of total household budgets dedicated towards housing. If it was a weighted number, it could have been 12%. Inflation would be 12%. Now that's a number that I think for those of us who have been selling a home, buying a home, who are actively out in the market shopping and buying, a 12% figure is eye-popping, but it's something that we've all experienced. It's also unsustainable, economically speaking. So we need to start to figure out whether or not this is going to be a short-term, AKA transitory trend, or something that's longer standing. So let's look at the different categories that have been impacted by inflation. I thought this was really interesting. If you look at apparel, if you go back a couple of decades, actually hasn't experienced much inflation at all. What you've seen there is you've seen the manufacturing of the manufacturing facilities. They've left Italy, left a lot of the European markets, and have gone to Vietnam and a whole bunch of other places in Asia and all over the Middle East. It's been fascinating to see, but that's kept the cost, the net cost of apparel down. Transportation costs up. There was a pocket here during COVID where transportation prices, car prices went down, but that has obviously since rebounded. And if you look, everything food and beverage, the trend is pretty consistent. The question is that, yeah, we know the cost of living goes up over time. I know the price of a movie ticket is going to be more in 10 years, more in 20 years than it is today. The question is that, are those rate of changes, is that too much? Is it excessive? And what you'll see is that the rate of change for most of these things, you can go back, the rate of change has been collapsing, meaning that this has been a sustainable, digestible rate of inflation for most of the goods and services that we use on a regular basis. That's a good thing. And if you look at the job market, the labor market, again, we talked a little bit about the challenge that the labor market will have with inflation. And a lot of that has to do with higher inflation and higher wages. What have we seen with the job loss situation? The permanent amount of jobs lost is certainly a heck of a lot better was in the financial crisis. I think we forget. In that 2008, 2009 time period, there were so many financial institutions, real estate related institutions, banking institutions that had significant dislocation and had substantial layoffs. We did not see those kind of layoffs. The kind of job losses we saw were short-term, they weren't permanent. And we haven't had a return back to full employment, but it's nice to see that the trend has reversed itself and it looks good on a lot of different levels. It was something that we were anxious to see was once the pandemic assistance programs went away towards the back half of this year in 2021, were we going to see people saying, all right, my unemployment benefits have gone down, they're not quite as much as they have been. Are they going to be jumping back into the workforce? Because if you look, the pandemic assistance is all but worn off. That extra level of financial assistance that we're given to people in the job market looking for jobs. So that has worn off, and we haven't seen a huge, sharp rebound in the job market, but it's been enough of a solid, stable, predictable, consistent, growing job market that it is extremely beneficial for the US economy, because we've seen more people continuing to come back into the job market, more people working, more earned income, more spending. We're a consumption-based economy. That's a net good thing right there. So we look at things like the misery index, and the misery index is it's two components. It's if you add inflation plus unemployment. If you have lots of unemployment and lots of inflation, not only have a lot of people that are out of work, you have a lot of people that can't afford basic goods and services. So the higher those two numbers, the higher the misery. And yes, we've seen this misery index increase significantly with COVID. There's been significant improvement, even with high inflation. The job market has improved so much that the net misery index is looking better. These are times where you say this has got to be a capitulation. This is time, these are times where, the world looks great, low inflation, great job market. The economy is ripe. So we're not quite back to those levels. We're certainly not at the panic levels yet either. So no news from the misery index that we have to be concerned about. One thing that we should note, though, is that as long as inflation continues to be a headline story and continues to persist, it's going to be something that's on the mind of consumers. And if it's on the mind of consumers, it may impact their spending. So look at this. Here in gold, what it shows is that kind of that inflation index, the CPI, the cost of living. You see here the big spike where inflation, did peak above 6% here as measured by CPI here recently. And then you've got consumer confidence. Consumer confidence can be, kind of like a Richter scale, where we had a high degree of confidence before the dot-com bubble burst, and then a high degree of confidence until the financial crisis. Confidence slowly, continually improved on a nice trend, until you had some concerns over the election. Then there was an improvement, and then COVID happened. What's interesting to note is that you've got this consumer confidence here that is also going down as inflation's going up. So we do need to look at consumer spending patterns. This could be, again, if inflation is persistent, something that's going to impact consumer spending. If high inflation does impact consumer spending, we're going to need to change some of our economic estimates because we don't expect it to be there. Because we've been lulled to sleep by these consistent and very low inflation numbers. Look at where we've been decade by decade. The 90s, 3% inflation, 2.5% inflation for the lost decade, 2000 to 2009. 2010 to 19, 1.78, and 2020 to the present, 2.61. But I can assure you that as the new numbers start to creep in, we're going to be well over that long-term average. Certainly a heck of a lot better than where we were in the 80s and in the 70s. But we've had a relatively calm period of time where all the Fed actions, despite all the different financial events that we've encountered, have rendered inflation relatively stable and predictable. We need to continue to watch it because, again, as long as inflation becomes persistent, we have to adjust our economic models accordingly. The vaccine rollout's been great, which has been very helpful for the economy. Economies not just here in the United States, but worldwide. You're seeing places that don't have widespread vaccine adoption being much more impacted, dramatically so, by potential economic shutdowns that some of those countries are facing because they only have 30% or less vaccine penetration for their population. Vaccine rollout's been great. The Fed's been accommodative. The White House has been accommodative with at least one, potentially two stimulus deals. One's already passed, the other one's in the offing. So we're getting all the possible accommodation that we could have. And, despite everything that's going on, we're starting to see inflation rear its ugly head, which could throw some cold water on our economic recovery that we've been having since March of last year. And we can't understate what the Fed has done with their injection of capital into the markets, their money supply creation. If you look here, what the Fed injected into the economy was epic and record setting. You can go back to 1961. The year-over-year growth in what the Fed has done to push money into the system was best identified here in this chart. This is, by the way, measuring the year-over-year change. So they're doing less and less to grow what they're putting into the economy. And in fact, the Fed has specifically stated that they'd like to taper, meaning they'd like to put less into the economy month after month after month. They're doing about $120 billion a month. They'd like to start stepping it down as early as December of 2021, this coming month. And we have to ask the question, like, if the Fed does that, can we sustain, and what will the market and the economy look like? What will inflation look like? And inflation has jumped partially because we've had such an influx in money supply as measured by this last chart. There were many pundits, many economists, some of the smartest people that I'll see on TV that were saying that we were going to have rapid and massive inflation given what the Fed was doing. They expected it a lot earlier, and they expected it a lot hotter than what it is now. So I have to say that given the amount of inflation that we have, yes, I'll acknowledge that it is higher than it's been in decades. it's still not all that bad, given the fact that it should be temporary because it's likely due mainly to significant supply disruptions that we're having from continued employment issues because we don't have everybody back into the workforce yet. We also have obviously the whole COVID issue that we had that quick little disruption to our supply chain, and that ripple effect is going to take us time to work through. That's having a huge impact on the price of goods and services that particularly that we're importing from overseas. So yeah, I wish I had more time, we would cover this, but let's get into a little bit about the relationship between the Fed balance sheet and then the market. What you'll see here is that in red, the Fed balance sheet increases. This goes back to 2007 financial crisis. The market goes down, the Fed balance sheet gets enacted, and the market finds a bottom. Market goes up. And as the Fed does a little bit less, the market responds. The Fed does more, the market responds. The Fed does less, the market responds. The Fed does more. Okay, same thing here. COVID hits, market goes down, Fed jumps in, market rises. And we're seeing there's this real definite pattern to, as the Fed is injecting capital into the system, the market responds very favorably. So when I say that we are a little bit concerned about when the Fed does start to taper, what that will do to our truly our S&P 500 returns, our stock market returns, there's a lot of data and information to corroborate the fact that it is potentially concerning. So it's something that we are watching. We think that there's a high likelihood that given the fact that we are dealing with the new Omicron COVID variant, that the Fed may have to push back when it's going to start to taper, which would, again, be supportive of the market and something we'd have to deal with down the road. But there and again, something that is an issue that we won't have to pay for right away, given the fact that the COVID uncertainty is going to force the Fed's hand to be more accommodative for longer. That accommodation hopefully will help the market, support the market activity. The reason why inflation is critical is that and we don't look at this often enough. We look at it often enough. I find that clients don't look at this often enough or consider this often enough. If we have a great year like we've been having, we have a 10% growth year, and let's say the annualized rate of return of large cap stocks going back to 1926 is at the average return is 10.4%. That's wonderful. But what you forget to consider is that the annualized rate of return after inflation is considered, because inflation's averaged about 3% since the 1920s, is a 7.4% return. The reason why it's critical is that the difference of where you are with that 3% differential is a dramatic amount in your wallet and in your pocket. This both underscores the need for people to invest their money to get growth, because in absence of growth, you really lose purchasing power over time because of inflation. And this also verifies the fact that the stock market is and has been the best liquid tool to grow client capital over and above inflation. In a way that bonds struggle to do it, in certain other areas of the market struggle to do it. So whether it be things like commercial real estate or private real estate or the public markets or private equity, those are the things that we're looking at to allocate client capital to based upon what the market and the economy are giving us, so that we can grow client capital over and above inflation, because over a long period of time, over a generation's period of time, it has a meaningful impact to your bottom line portfolio. I thought this chart, for me, as you guys know, I'm a nerd for this stuff, was the most interesting. Is that when we have super high inflation, it's actually been the worst performing stock markets. Or if you have negative inflation or deflation, it's been the second worst performing area of the market. So the market hates deflation or the cost of living going down every year. If the cost of living is going up, there's this sweet spot, this 1 to 4% where the market typically performs the best. And that doesn't necessarily mean that all areas of the market perform the same. We're aware that when you have high inflation, the highest level of inflation, greater than 5%, gold, commodities, inflation protected bonds, those are the three best performing areas to invest in. We have to figure out, are we going to be more in the growth stock space or the large cap stock space, which tend to perform better in this kind of inflation environment? Where are we going to be? What is the market going to do? And how can we best navigate our client portfolio? Because not all areas of investing go up and or down the same in different inflation environments. So we'll continue to look at it. We're going to continue to navigate it and do that work for your portfolios. If you look at the U.S. dollar deflated by CPI, look, I mean, what a dollar used to be worth back in 1913, it's worth pennies today. Pennies. Inflation has that long-term drain effect on your capital. Inflation, the cost of living rising every year, makes it imperative that you invest and grow your money somewhere so that over a long period of time, you can outpace and outlast the effects and impacts of inflation. That's what we do. And if you look at the real yield, this is the fact that we know that your bank accounts, your checking accounts are earning about zero. Well, if you look at that 3-month real yield, which is that short-term rate of return, which is effectively zero minus inflation, it actually hit -6% for the first time since the early 80s, late 70s. This has been a super difficult time to hold money in cash. If you're holding a bunch of money in cash, just know that on an inflation adjusted basis, you pulled a -6. I want to acknowledge the fact we're not gold bugs, you guys know that, but I do want to acknowledge the fact that there has been an interesting dislocation. The fact that normally there's this relationship that as inflation goes up, gold goes with it. As inflation goes down, gold goes with it. It tends to be more volatile. But gold has gone down and inflation's gone up. This is the first time really going back many decades that we've seen this kind of exact opposite inverse relationship between those two things. So you might see us put a position on in gold miner stocks because we think that will reverse itself some point here soon. In crude oil, this is the kind of marriage you normally see: inflation up, inflation down, oil up and oil down. These things have been working in perfect harmony with one another. And as I mentioned, if you look at how assets and investments are correlated, we do pay attention to these things. So we do find areas of diversification. So we best know how to combine assets to make sure that your portfolios work in all market environments. I'm just going to leave the disclosure up here for a second so you can all take it in and read it. So point is, inflation's running hot. We know it. The supply constraints seem to be short-term, seem to be transitory. If that continues to be the case, then we think that inflation is something that we will get through, get over. And we think, much like the estimates are expecting, the rate of growth in inflation continues to go down through 2022, continues to normalize. Do we settle in this 4 to 5% range? Is it more the 3 to 4% range? Do we go back to our recent historical norms of under 3%? Hard to say. It depends on how long these supply disruptions last. All in all, we're going to continue to work to navigate the portfolios, finding the right areas of the market to invest in, the right areas of opportunity. If you have any questions about this video or anything about your portfolio, you can always drop us an email or give us a call at any time. Well, that's it for your inflation class of the day. I look forward to speaking with you soon. Take care. Have a great day.